Is it unrealistic to think the narrative for growth will return in 2023? In 2021, the market rewarded any Tom, Dick, and Harry who could properly pronounce the word innovation, lifting company stock with dot-com level price targets and hitting the news feeds to help them promote their fluff. But now it's not too hard to see these expectations were too outlandish to come to fruition. It's not about the Fed. It's about our failed attempt to game the system. Operating cash flow growth in the tech sector is seen slowing in the most recent quarters. If things go back to what they were before the pandemic, there could be very brutal quarters ahead for some of our largest companies. Thank you for tuning in. This is Total Return with Division 1 Finance, where we provide the highest quality stock market analysis to individual investors. My name is Jerome Forbes, and today is January 8th, 2023. Our main focus, as usual, is going to be on market-moving catalysts and internals of the S&P 500. Before we get started, I want to remind those listening to subscribe and turn on your notifications because every time we drop a new episode, money is made. This week feels like it's going to hit a little different. Consumer inflation expectations for the year ahead come in on Monday after November gave us the lowest one-year inflation expectations since August of 2021. This may sound like a major plus for the stock market, but it wasn't enough to sustain a rally in December as the SPY ETF closed $12 lower 4 days later. One-year inflation expectations are expected to be unchanged at 5.2% on this latest report. Tuesday is going to likely be the second most impactful day of the week, kicking things off with the Small Business Optimism Index. On last month's report, the NFIB chief economist stated inflation and worker shortages remained major issues for business owners, and most of the readings were still consistent with a recession and weak economic activity. 2022 had lower readings for small business optimism than the pandemic, and this week's report is projected to be the lowest reading in 5 years. I can't imagine a reading that low will lead to anything other than renewed fears of a recession and lower projections for the S&P 500 carrying over into the second quarter. If that's not bad enough, Jerome Powell speaks later in the day, and I can't imagine he's going to tell investors what they want to hear. After the unemployment rate fell to 3.5% in December and non-farm payrolls came in higher than expected. Inflation is projected to have a meaningful decline year over year and show some signs of stability on a monthly basis. But disappointing numbers here could have major consequences. On one hand, it would lead to an immediate sell-off in the stock market. On the other hand, it would lead to the Federal Reserve sticking to the higher for longer narrative in relation to interest rates. This will continue to put pressure on already dampened growth expectations that have all but died in 2023. This should also be a major test of balance sheets and a killer of cash flows for companies as they have to find ways to finance operations at elevated costs. Investors should definitely pay attention to JP Morgan and Bank of America earnings on Friday, giving us an inside look into the economy through their earnings calls. We should be able to get some insight on consumer savings, whether lending slowed further in the fourth quarter of 2022, and many other things. JP Morgan saw revenue grow nearly 8% in 2022, but earnings for the major bank declined by 23% year over year. Bank of America also saw nearly 8% growth in revenue, but suffered a much less punishing 9.8% decline in earnings. Both banks are projected to see earnings growth this year, but unfortunately, they're also projected to surprise to the downside on Friday. BlackRock and Bank of New York are the only financial institutions reporting on Friday projected to surprise to the upside. Taking a look at the entire market from a technical perspective, the SPY ETF closed just above the monthly support of 387 on Friday, showing investors are hoping for a positive outlook to come out of this week's economic and earnings reports. But what we wish for is not always what we get. In this type of environment, the probability of finding yourself disappointed by current events is not uncommon and far from unlikely. Just ask Cathie Wood. Back in October, she issued an open letter to the Fed urging them to stop raising interest rates. The ARK Invest CEO claims to have her finger on the pulse of innovation, but since rate hikes began back in 2022, has found her flagship ARK Innovation ETF hanging on for dear life. Of course, her plea to the Fed didn't work, but as far as innovation goes, it was by far the most innovative attempt at saving a dying mutual fund I've ever seen. I think if it's one thing we've learned in 2022, it's not to hitch your wagon to fund managers or CEOs who promise outlandish and unsustainable growth. Seeing as we're on the topic, is it unrealistic to think the narrative for growth will return in 2023? In 2021, the market rewarded any Tom, Dick, and Harry who could properly pronounce the word innovation, lifting company stock with .com level price targets and hitting the news feeds to help them promote their fluff. But now it's not too hard to see these expectations were too outlandish to come to fruition. It's not about the Fed. It's about our failed attempt to game the system. Operating cash flow growth in the tech sector is seen slowing in the most recent quarters. If things go back to what they were before the pandemic, there could be very brutal quarters ahead for some of our largest companies. Sustained growth due to low interest rates has ended, even when rates finally come down. My advice for investors is look for value. Find stock in major companies that take a temporary spill and hold on for the long term. Don't believe CEOs that tell you they're pushing through unscathed, and definitely don't put all of your eggs in one basket. If you decide to invest in high growth, look for sizable margin of safety. If you're not financially savvy and normally don't set your own price targets, look for a margin of safety at least 15% below the average analyst target. Say no to any stock that doesn't give it to you. The S&P 500 is projected to see earnings growth of 4.4% in 2023, well below the 10-year average of 8.5%. Earnings growth projections have been declining for the entire market minus a few expectations. Despite nearly 80% of the market participating in Friday's rally, there were just as many 52-week lows as there were highs. Without a doubt, this is a result of growing concerns over a potential recession. But now it's time to get to the nitty-gritty. Every year, I release my very own price targets for the S&P 500. This will be my first time doing it live on our podcast. As of tonight, those numbers are finally in. Before I reveal what they are, I would definitely like to remind everybody listening that my research is shared daily across all social media platforms. If you're on Twitter or Instagram, be sure to follow at D1Finance. Without any further delay, these are my S&P 500 price targets for 2023. I will be converting them over to prices relevant to the SPY ETF as usual. Now, according to Refinitiv, S&P 500 earnings estimates from all analysts across the market is for earnings to grow 4.4% to $229 in 2023. This puts 2022 earnings for the S&P 500 at $219. Worst case scenario for 2023, if the S&P 500 actually can live up to growth expectations, is around 325. This would likely mean that even though companies have been resilient and able to find growth, the inflation narrative decided to stick around, and potentially we saw a recession hit before the year's end. Best case scenario, which would of course see us avoiding those narratives while also achieving the growth expectations, would be around 485. In a no-growth scenario, which means the S&P 500 was unable to see any growth in 2023, would bring our targets down a notch. Worst case scenario would be around 311, and best case scenario would be 462. Traditionally, I take both scenarios and create average price targets as to not have a ton of numbers running around in our heads. So here's what it looks like. Average on the worst case side, we have 318. Average on the best case, we have 474, which leaves my average price target for 2023 for the SPY ETF at 396. Investors that want to keep track of these price targets can set notifications or trend lines across their charts. I will be posting updates on my price targets and where the market is currently headed across social media. For those of you who want to tap in with me on a more personal level, I recommend downloading the Clubhouse app and following the Division 1 Finance Club. I do live sessions every Tuesday morning, and I teach a free class on stock analysis and trading every Saturday, and everyone's welcome. That's all the time we have for this particular episode. Be sure to hit that follow button and turn on your notifications, because every time we drop a new episode, money is made.